Welcome to Outlook 2026. In this episode, we will explore the evolving landscape of China and India equities, two powerhouse markets in Asia that offer distinct investment opportunities. Our latest strategy upgrades Indian equities to overweight while maintaining our overweight stance on China within Asia ex-Japan. Why? India stands out for its premium growth while China offers discounted valuations, and together they provide complementary exposures for a diversified Asian portfolio. Interestingly, the correlation between Indian and Chinese equities has shifted. Over the past 5 years, the relative performance of the two markets moved in the opposite direction. This means that either India or China has been outperforming the Asia ex-Japan equity market index, but not both. After a prolonged period of Indian equity dominance, 2025 was China's turn to shine. This either-or phenomenon is actually relatively new. Since 2000, there have been several periods when both outperform within Asia. So why do we expect both to outperform in 2026? As we like to say, India is a strong structural story with high valuations, and China is a weaker structural story with inexpensive valuations. In early 2025, Indian equities were trading at high price-earnings multiples, and earnings growth proceeded to disappoint elevated expectations. However, India remains one of the fastest-growing emerging market economies, with GDP expected to expand around 7% over the next 12 months. Meanwhile, inflation has moderated significantly in 2025 and is expected to remain benign in 2026. This year's starting point means expectations will be easier to meet or exceed going forward. Valuations in terms of price to earnings and price to book ratios have moderated, and earnings growth is expected to accelerate in 2026. Meanwhile, the return on equity for the market as a whole is still in the mid-teens, above the Asia ex-Japan average. Chinese equities, meanwhile, offer value. Growth has steadied, with the government likely to achieve its 5% growth target for 2025. The government's anti-involution policies are likely to reduce competition, put a floor under inflation, and support corporate profitability. Meanwhile, the latest 5-year plan emphasises technological self-reliance, setting the stage for structural growth. We prefer offshore Chinese equities as they're more liquid, trade at a discount to regional peers, and offer greater exposure to growth sectors. While the robust stock market performance in 2025 has increased valuations, they remain far from extreme levels and still trade at a huge discount to global equities. Of course, risks remain. Geopolitical tensions and tariffs are the most obvious risks to both markets. However, we see such volatility as likely temporary, and therefore an opportunity to increase exposure rather than reduce it. Thank you for your time. Please tune in to more Outlook 2026 videos to help you navigate your wealth journey with clarity amid global shifting currents.